Hi, I'm James Dunn. Welcome to the Inside Network.
Welcome to INDepth, brought to you by the Inside Network, and my guest is Patrick Tissot-Favre, Head of International Business Development at Amundi Employee Savings and Retirement, based out of Paris. Without a doubt, Australian super funds are facing a challenge in preparing to meet the demands of a rapidly ageing population and members nearing retirement. Recent trends have shown that retirement is a major factor in members exiting pooled pension funds. In order to slow this trend, funds are being forced to innovate to provide functional solutions for members to carry their super with them well into retirement. The good news is this is not a new problem for offshore investors or asset owners. They've been dealing with this for many years. In September this year, the Inside Network partnered with Amundi Asset Management to bring together a number of Australia's leading superannuation and financial management experts across 3 engaging roundtable conversations titled Solving the Retirement Riddle, to discuss whether we really appreciate the problem in this country, and if we did, where are we up to in solving it? And what we can learn from those who've already done the work overseas. And that's where Patrick comes in. Patrick is the Head of International Business Development at Amundi Asset Management. Patrick joined us in all 3 roundtables, and I wanted to bring him back to share some of the insights we covered at those events and what he thinks we should be focusing on going forward. Welcome, Patrick.
Yeah, good afternoon.
And thanks for joining us again in what's been a whirlwind few months. The recent release of the Australian Government's Retirement Income Review has once again brought the focus back to post-retirement solutions. Now, having dealt with this difficult transition in Europe for more than 20 years already, can you provide us with your broad assessment of the Australian retirement solutions marketplace and that riddle that we're facing? Are we across the key issues in your opinion, and do we really appreciate the potential impacts of retirement on our superannuation system?
As you said, the retirement riddle is not only in Australia, it is across the board, and the magnitude of the problem varies according to different parameters, which are mainly the age structure of the population. We have globally a growing aging population, and the pace at which the world is getting older is even accelerating in some region. And second, the existing retirement schemes and the strengths of each pillar, whether you have a DB or a DC, for how long it is in place, and its generosity. And on top of that, you have the economic environment, which is not helping at all, with low interest rates since the great financial crisis. And this long period of low interest rates has complicated wealth accumulation and savings for retirement. And needless to say that we are not done with this situation. Against this backdrop, and whatever the pension scheme, replacement rates are likely to decrease in the future. So what is considered a good post-retirement solution? I think it comes first with a good accumulation solution. You should not think about decumulation when you reach retirement, but much before, in order to take the right decision and to adjust your savings accordingly. When reaching retirement, people want return with low risk. They want the security of an income, but also flexibility. And with regards to Australia, it seems the problem of post-retirement income is well identified, and it is being addressed by your government with the so-called CIPR, the Comprehensive Income Product for Retirement, and also by the industry. And it seems that there is an agreement about the need for post-retirement income, but still maybe some debates about how it should be structured and implemented. But as it is a very complex problem, there is no obvious solution, and all the discussion we had just illustrate the challenges of post-retirement solutions.
Now, Patrick, I understand Amundi has been working with a number of Australian funds to provide tailored solutions. Can you share some insights into what has worked and has not worked well, firstly in terms of implementation and then in the member response?
Yes, actually, there is a gap between what members want and what is realistic. Basically, you have to combine security and flexibility, and it is difficult to combine both. The current product offering is mainly the choice between, first, the security of a lifetime income with an annuity, but the annuity is expensive and is irreversible. So meaning you are losing the flexibility. That is why there is little appetite actually for life annuities. And the second solution is the flexibility with income drawdown, scheduled drawdown. You decumulate by yourself, but with the risk of exhausting your capital before your death. You keep the liquidity, but you are losing the security. But actually people want both. And at the end, there should be a trade-off between an income stream, risk and flexibility. So how can we address security and flexibility in the decumulation phase? At retirement and progressively when getting older, retirees are getting more risk adverse. So that is why we believe that protecting the capital during the decumulation is critical. This is the reason why we have developed protected solutions for decumulation. Typically, the idea is to guarantee a level of income and a level of capital protection over the long term. For instance, 5% per annum of capital drawdown with 50% of capital guarantee at the end, or 60%, it depends on the interest rates, for a period of 10 years. So this solution can be, of course, customized in terms of income and capital protection to suit the different needs and spending behavior of the retirees. So we believe these strategies can offer a good mix of security and flexibility, even if it is for a defined period of time. So we have designed these solutions, for example, in Europe and in Japan a few years ago. So of course, today, the figures would be probably less appealing because of the level of the interest rates.
Patrick, during one of our discussions in which you participated, we heard from a number of well-known super funds here in Australia about the solutions that they've created for their members. Do you think that funds should be looking to work in isolation or collectively with the broader industry to resolve this? And how does, in particular, working with an offshore partner fit into the broader equation of what a fund needs to do?
Well, definitely combining forces or capabilities better, provided it helps at the end to end up with a solution. I noticed indeed that basically all the people we listened agreed on the global picture, you know, income, need for income, low risk, flexibility, security, and of course that one size doesn't fit all because there is no one solution for everyone. But implementation may differ because situations and needs are different among the supers, depending on their members, on the age structure of the members, the level of savings, etc. And of course, customization has some limits as well because you cannot create thousands of products. It's not feasible. So maybe we can group people from different supers and having the same profile in terms of age, risk profile, and into a single product or range of products instead of having each super creating its own solution. It would be better for everyone in terms of cost efficiency for sure. And to some extent, Amundi may play a role in facilitating that kind of work and proposing a product that can meet those needs. Of course, working with an offshore partner can bring different views, different experience, and different ways of addressing a problem. You know, we are in contact with many countries having to solve the same issue of accumulation and decumulation, but with different regulatory environments. And I think we can definitely take ideas from them and also bring ideas to others.
Patrick, it seems an obvious choice to have a target income strategy for drawdowns adjusted each year, but we learned in our roundtable discussions that there are inherent risks to this strategy, and those include changes in economic conditions, interest rates, and investment strategy, and all of those, or a combination of factors, can derail the solution. So how has Amundi worked around these limitations? And following from that, what approach do you believe is best suited to the situation, the unique situation that Australian pension funds face in this country?
Well, you just actually pointed out the shortcomings of the target income strategy. Of course, it gives a yearly income objective that is a percentage of the capital, but it is adjusted each year. Meaning what? Meaning the amount varies, meaning that there is an uncertainty at the end of the income you will get. And in addition, resetting annually the income objective, I think it's not very consistent with the long-term horizon of the retirement, where individuals are looking for a higher degree of security in their income and capital. So this is the reason why we, for long-term accumulation, we prefer income drawdown strategies, where you can have a certainty of the amount paid out. With this solution, you also have the leeway to adjust the parameters according to the needs by just changing the level of drawdown. So actually, security is mainly needed when you are getting older, from 75 or 80, not at the early stage of retirement. That is why what we suggest is to split the retirement period in 2 phases in order to answer to the needs that are changing as time goes by. It is outcome oriented and scalable. So what we proposed is for a first period of 10 years, for example, to have a certain income drawdown as a percentage of the initial capital with a focus on capital preservation. And then the second phase, after 10 years, is to continue the income drawdown with the same level of distribution, or higher or lower, but with the possibility at any point in time to convert partially or fully your capital. And as you know, for an annuity, the cost of conversion is cheaper when you do it later. The closer you are to the the kind of the life expectancy, the cheaper it is. So you secure your consumption needs in late life while maintaining flexibility. I think with that kind of solution, you can continue with an active management, and you can expose part of the capital to risky assets in order to capture the equity risk premium with the double objective of securing the minimum replacement income and also offer the possibility to generate an even higher income through this higher risk taking. It is not actually that very different from the pension-based account, but I think the addition is the possibility to convert it to an annuity, which provide kind of security.
You've mentioned the term decumulation a couple of times, Patrick. Now, a lot of Australians obviously are familiar with accumulation within the context of the superannuation system, but could you talk us through what decumulation is and what are the ramifications of decumulation and how it differs to the many views around the marketplace for solving the retirement income riddle?
Mm-hmm. Well, decumulation is just transforming your accumulated assets at retirement into a steady income that can last your lifetime. I will make 3 remarks. First, the accumulated assets that make actually the funding for retirement come from a combination of sources. So in Australia, you've got the age pension, the super, and the voluntary savings. Second, we are living longer, and consequently, the retirement is lasting longer as well. And there could be a risk of exhausting your capital before your death. That is the longevity risk. And third, the needs are very different depending on the situation of each individual in terms of wealth, age, health, housing, income objective, lifestyle objective. That is why decumulation is complex, because the situation is different for each and everyone. The situation is different, but the objectives actually are the same. And decumulation should meet 3 objectives. First, secure the essential consumption needs. Second, to cope with liquidity needs for exceptional expenses. And third, to, if possible, transfer capital to your kids. So solving the retirement riddle is meeting these objectives, actually. And to answer these objectives, individuals want flexible options at retirement. And concretely, I think there is a preference for retirement savings that continue to grow after retirement in order to keep the flexibility and in the meantime to receive a regular income.
There was a lot of discussion in the roundtables, Patrick, about the role of governments and regulators in setting the policy and the frameworks for the industry to use. And quite a bit of work has been done to date. But over the course of the discussions, it became clear that more can be done and more would be welcomed by the industry. So you've got experience with working with partners in Europe and Asia. Can you explain how important it is to have a strong framework in place to help guide these discussions and to help the industry come up with quality products and services that have real impact and real benefit to members?
Well, you need a framework, of course, and the framework is also evolving to adapt to the environment. And a solid framework gives confidence in the system because it is here to protect the individuals. And globally, so far, regulators have done a lot to better protect and better inform investors. But I think even more should be done, especially to better educate. We all know that financial literacy is rather low, and that can lead people to take, to make unsuitable decisions or to not take any decision at all, which is not good. And I think also we should increase the regulator, to some extent, should increase the awareness regarding retirement. There is a need to improve the understanding of the system so that everyone can enjoy the best benefits at retirement. There is also a need to engage members on retirement much in advance to anticipate. And there is a need to support people in finding the right solution by advising, maybe making some simulation. How will I get when I will reach retirement, etc. So choosing the best way to convert retirement savings into a stream of income is a complex decision. Accompanying people to do that is key. And, at the end of the day, whatever the framework, it's very important, but there is no perfect solution fitting everyone. The solution at least should be simple, provide a regular lifetime income, be flexible enough to be able to change if needed, and provide sufficient liquidity.
In our roundtable series, Patrick, you heard from some of Australia's most experienced superannuation and retirement professionals across funds themselves. There were advisors, there were consultants, there were regulators, there were industry experts and commentators. What surprised you the most about the Australian retirement solution landscape, and what advice would you give the Australian industry in terms of moving forward to solve this retirement riddle?
Well, Australian pension scheme is recognized as one of the best in the world. You can look at the surveys, so I'm wondering if it is not the Australian industry to give advice instead of receiving advice. So anyway, to solve the retirement riddle, I think there is not one solution, but a combination of solutions. I would also say that anticipation is key. There is a big demographic trend that is irreversible, so resulting in imbalances in the retirement landscape. Of course, it is contrasted according to countries, but in most countries, people are not saving enough for their retirement because maybe investing for retirement may seem a little bit abstract. It's so far away. And what should be done is to encourage people to save as early as possible, to save regularly and to save significantly, just to build up their retirement savings. And to that respect, and because it was in the discussion we had, I think early release of retirement saving is not a good thing because the purpose of retirement saving is for retirement. It has not to be used before. I understand that in some exceptional cases it could be, but you are losing a lot in terms of capital growth. And when possible, I think the decumulation and the accumulation should be embedded in the same solution or product. Why is this? Because the asset allocation you have during the accumulation depend also, and especially when you are approaching retirement, depend on the exit option you are choosing, whether it is a lump sum or scheduled drawdown. And then the level of risk is adjusted accordingly. If you are exiting with a lump sum, we are de-risking the portfolio much in advance compared to scheduled drawdown. And the second remark I will make is, what about maybe a default option at retirement? I think default option can be beneficial for people who are unable to choose or unwilling to choose. I think for accumulation, default option have proven to be an effective way of helping people, guiding people to select the appropriate investment decision. So if you have a kind of similar, it could have a similar effect on helping individuals to convert retirement savings into income. It should not be mandatory, but it could just provide significant value to a large number of retirees. And this default option could be a separate fund or solution in which an individual could be automatically enrolled or not, could be an option at retirement, for part or for full of his assets, and with the option to opt out if he doesn't want to have this default option. But it should be flexible enough to allow individual to make changes during retirement if their situation is changing.
Thank you, Patrick. It was a pleasure having you involved in our retirement solutions roundtables, and again, a pleasure today to catch up in depth. My guest has been Patrick Tissot-Favre, Head of International Business Development at Amundi Employee Savings and Retirement. Thanks again, Patrick, and have a wonderful Christmas and Happy New Year.
Thank you, James. You too.
Bye-bye.
Bye-bye.